Hey everyone, and welcome back to another explainer. Today, we're taking a pretty fascinating trip, literally straight onto the factory floor. We're diving into Phase C, manufacturing and cost accumulation. Think about it for a second. How exactly do you take the physical, incredibly messy reality of grinding gears, sweating workers, and raw materials, and then flawlessly translate all of that into clean, perfectly balanced financial statements? Well, let's dive right in and find out exactly how it's done. All right, so here is our map for today's journey. We're going to hit 6 key areas. First, we'll go from standards to reality. Then, tracking work in process. Third, allocating labor and overhead. Fourth, handling spoilage and scrap. Fifth, calculating the cost of goods manufactured. And finally, number 6, we'll dive into absorption versus variable costing. Okay, let's kick things off with Section 1, from standards to reality. So the whole process, it all starts with a single spark, right? The production order. This is basically the work order raised directly from your approved bill of materials, and it officially triggers the production run. Once this order is fired off, materials are released from the warehouse. This happens via a specific document called a material requisition note, or an MRN. And at this exact moment, the cost physically shifts. It moves from raw materials inventory right over into work in process. Now, how we actually track that accumulating cost, well, that depends entirely on the type of factory we're running. If we're, say, building custom luxury yachts, we're going to use job costing, where we track costs by that specific order. But if we're brewing thousands of gallons of soda in a massive continuous flow, we use process costing, which accumulates costs by department for the entire period. Now, there's a key rule you've got to keep in mind here. Regardless of whether you're tracking by a specific job or through continuous process departments, both systems use the exact same standard costs as a benchmark. I really want to stress this. The standard? That is your universal North Star. The only thing that actually changes between these two systems is simply the methodology used to track the actual costs that are happening out there on the floor. But well, here's a dilemma for you. What happens when the material mix, or the yield, or the scrap, deviates from that original pristine standard? Because, let's be honest, reality is rarely perfect. What if your team uses the wrong blend of steel and aluminum for an alloy, causing a mix variance? Or consider this. What if 100 kilograms of raw input is supposed to yield 90 kilograms of finished output, but it only yields 85? That missing 5 kilograms, that captures a real-world inefficiency, which we logically call a yield variance. And honestly, this brilliantly illustrates exactly why factory controls just have to be incredibly tight. So here's an insider tip, a real watch-out moment. All excess material requisitions that go above the bill of materials standard quantity, they require supervisor approval, and they are immediately flagged as material usage variances. Think about it. If a worker messes up and needs more material, they can't just quietly sneak over and grab it from the warehouse. Nope. It triggers a strict approval process, which instantly flags the inefficiency so management knows exactly where the money is leaking. All right, moving right along to Section 2, tracking work in progress. Welcome to the messy middle. Let's take a closer look at our 2 primary tracking choices. On one side, we've got job order costing. Imagine a custom furniture shop. Here, costs are updated as they're incurred on specific job cost sheets. Materials come from the MRN, labor comes from time cards, so the total work in process balance at any given time. It's just the sum of all those open sheets. Now, on the flip side, we have process costing. Think of a massive paint factory. Costs build up by department over a specific time period, rather than by a specific batch. To value the inventory flowing through a setup like this, we have to use either a FIFO or a weighted average flow assumption. Now here is an absolutely classic factory dilemma when it comes to process costing. How in the world do we fairly divide our total process costs between the units that are completely finished and the partially complete units that are just still sitting out there in work in process? Think of it this way, just a relatable metaphor here. Let's say you're baking cookies and the timer rings to end the accounting period. You might have a dozen fully baked cookies and a dozen that are, well, only half-baked. How do you assign a fair, mathematically sound cost to a half-baked cookie? Well, the exact solution to our half-baked cookie problem is a really clever concept called equivalent units, or EUs. An equivalent unit is simply the number of physical units multiplied by their percentage of completion for that specific cost element. So let's say you have 10 half-finished units, meaning they're 50% complete. In the eyes of a cost accountant, that is the mathematical equivalent of 5 fully finished units. It's an ingenious metric, really. It allows us to calculate a fair cost per unit, which we then use to value both the goods transferred onward and the goods left sitting in ending inventory. Okay, let's jump into Section 3, allocating labor and overhead. First on the board is direct labor. This is strictly the time worked directly on production, usually captured via time cards. But what about the floor supervisor or the maintenance crew? Well, that is not direct labor. That falls under manufacturing overhead. And overhead is tricky, so it's applied using a two-step allocation based on what we call a predetermined overhead rate. And just briefly, what happens when one process makes multiple distinct things? Think of refining crude oil, which yields gasoline, diesel, and jet fuel all at once. These are called joint products. The costs incurred before they become distinct, which we call the split-off point, must be allocated. And this is most commonly done by looking at the relative sales value or net realizable value at that exact split-off point. Now, definitely make a mental note of this key rule regarding overhead. Because we apply overhead to work in process using a predetermined estimated rate, there is almost always going to be a difference when compared to the actual overhead bills that roll in later. So if your actual bills are less than what you applied, you have over-applied overhead, and hey, that's a favorable variance. But if your actual bills are greater than what you applied, you have under-applied overhead, which is an unfavorable variance. Cementing this difference in your head is absolutely vital for understanding a factory's profitability. Which brings us to Section 4, handling spoilage and scrap. When things get ruined, it all comes down to a very strict dividing line: normal versus abnormal spoilage. Normal spoilage is fully anticipated. It happens even under the absolute most efficient operating conditions. And because it's just an expected cost of doing business, its cost is capitalized right into inventory, meaning the cost of those ruined units is spread across the good units, which slightly raises their per unit cost. Abnormal spoilage, on the other hand, that is caused by unanticipated machine malfunctions, operator error, or just totally substandard materials. This is considered avoidable, so it is absolutely not capitalized. Instead, it's immediately recognized as a period expense, taking a direct, immediate hit on the income statement. And this brings us to an incredibly important warning to watch out for. Including abnormal spoilage in the cost of your good units would penalize them for an avoidable failure, completely distorting your per unit cost. Just think about the logic here for a second. If a forklift driver accidentally backs over a pallet of perfectly good finished goods, you shouldn't artificially increase the standard cost of your remaining inventory to cover his mistake, right? Doing that would distort all your efficiency metrics. No, that loss belongs exactly where it occurred, expensed immediately in the current period. All right, we're nearing the end of the line. Section 5, cost of goods manufactured. Let's walk through this, step by step. The cost of goods manufactured, or COGM, formula. Step 1, you take your beginning work in process. That's what you started the period with. Step 2, you add your total manufacturing cost for the current period. So that's your raw materials used, your direct labor, and your manufacturing overhead applied. Step 3, you subtract your ending work in process, the stuff that's still half-baked out there on the floor. And step 4, what remains equals your cost of goods manufactured. This number is literally the exact dollar value that physically transfers out of the factory doors and into the finished goods warehouse. So the massive takeaway here is that the COGM statement is the absolute central document of manufacturing cost accounting. If you're aiming to be a solid accounting advisor, mastering this specific calculation and being able to confidently reconstruct it from a giant pile of messy source data is completely non-negotiable. It is the definitive bridge that connects the chaotic factory floor to the clean financial statements. Finally, let's hit Section 6, absorption versus variable costing. We need to perfectly contrast the two primary ways to treat these costs. First, under full absorption costing, which, by the way, is strictly required for external reporting, fixed manufacturing overhead is capitalized right into inventory. It basically sticks to the product. But under variable costing, which is used internally for management decisions, fixed overhead is expensed in the exact period it's incurred. Variable costing is what managers actually use for things like break-even analysis and pricing, simply because it isolates the costs that actually change with volume. Now, what is really fascinating here is the income effect this whole thing creates. When a factory produces more units than it actually sells, absorption costing will suddenly show a higher net income than variable costing. Why? Well, because under absorption costing, a chunk of those fixed overhead costs are hiding. They're hiding inside the unsold ending inventory sitting on the balance sheet, rather than hitting the income statement as a current expense. This creates a really dangerous incentive. Managers can actually artificially inflate their short-term income by simply running the factory in overdrive and overproducing a bunch of inventory they don't actually need. Which leaves us with this final, truly provocative thought to wrap up today's explainer. If variable costing gives managers a much clearer picture of efficiency and completely prevents that dangerous incentive to overproduce, why do standard setters still strictly mandate absorption costing for external reporting? Does tying fixed factory rent to an unsold product truly reflect economic reality, or does it just obscure it? I really challenge you to ponder that conflict between internal efficiency and external reporting rules. Thank you so much for joining me on this journey through the factory floor today, and as always, keep learning.